Vanguard ETF investing is not hype, luck, or speculation. It is one of the most reliable ways for everyday investors to build long-term wealth and sustainable passive income in the stock market. While most people lose money chasing trends, paying high fees, and reacting emotionally to headlines, disciplined investors understand a powerful truth. Simple, low-cost ETF investing works. This philosophy began with Vanguard itself. In 1975, Jack Bogle challenged Wall Street with a radical idea that reshaped investing forever. He asked why investors should pay enormous fees to fund managers who consistently fail to beat the market. That single question sparked a revolution and gave birth to Vanguard's investor-first model, built on transparency, efficiency, and long-term growth. Today, Vanguard oversees nearly $12 trillion in assets. Vanguard ETFs offer broad market exposure, ultra-low costs, and the ability to compound wealth quietly and consistently over time. Some Vanguard ETFs charge expense ratios as low as 0.03%, meaning a $10,000 investment costs just $3 per year. That difference may seem small, but over decades, it can mean the difference between financial stress and financial freedom. In this video, I'm going to show you and Bobby what a one-time $50,000 and a daily $5 investment can truly become when it's handled the right way. No stress, no gambling, no chasing risky trends. Just a clear, proven strategy built around the 5 best Vanguard ETFs. The first ETF provides the opportunity to invest in America's top 500 companies with steady, reliable growth. The second ETF provides quality income, emphasizing stable companies with consistent dividend growth histories. The third provides the opportunity to own the entire U.S. economy through the broadest diversification in a single fund. With the fourth ETF, investors can earn high dividend income while diversifying globally beyond the U.S. markets. And the fifth provides explosive returns in the technology sector for maximum long-term wealth building. You'll see exactly how that money can grow inside each fund, step by step, using the power of long-term investing and compounding. And at the end, I'll reveal an exceptional ETF that could transform a one-time $50,000 and a daily $5 investment into a whopping $6 million portfolio over time. Listen, every year, millions of people unknowingly commit a $50,000 mistake, not by losing money, but by never allowing it to grow. It sits idle in low-interest accounts or disappears through impulsive spending. The line between lifelong regret and financial freedom is rarely income. It is the discipline to make smart, intentional financial decisions. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Claiming the first spot on our list is the Vanguard S&P 500 ETF, ticker symbol VOO. This unique ETF is widely regarded as the foundation and cornerstone of long-term investing because it represents ownership in the core engine of the American economy. When investors buy VOO, they are not betting on a single company or idea. They are buying a stake in the 500 most powerful and profitable businesses in the United States, including Apple, Microsoft, Amazon, and Google, all in one simple move. This is why seasoned investors start here. It captures the market itself. What makes VOO devastatingly powerful is its relentless, built-in intelligence that operates on autopilot while you sleep. This Vanguard ETF constantly purges itself, ruthlessly eliminating declining companies and seamlessly replacing them with emerging market dominators like Nvidia and Tesla, before most investors even recognize the shift. You never waste time guessing which stocks to buy, frantically trading out of fear, or reactively chasing headlines that destroy wealth. The market naturally evolves through economic cycles and technological disruption, and VOO intelligently evolves with it, automatically repositioning your portfolio for maximum long-term growth without requiring your intervention. VOO eliminates complexity. There is no stock-picking stress, no endless research, and no emotional decision-making. You invest once and let time, growth, and reinvested profits do the work. Over the last decade, VOO has delivered an average annual return of about 13.6%. This reliability is why investors call VOO the Cornerstone. Now, let's dive into the numbers. We will use two formulas to calculate the future value of Bobby's investment portfolio based on two types of contributions: lump sum and regular contributions. The first calculation handles any lump sum amount Bobby is starting with today. It takes Bobby's present value and grows it over time using compound interest, with the growth rate applied repeatedly in each period. The formula multiplies Bobby's initial investment by 1 plus the rate of return, raised to the power of however many periods Bobby is investing for. The second calculation addresses regular contributions Bobby makes over time, such as monthly deposits. This is called an annuity, and the formula accounts for the fact that each payment Bobby makes will have a different time horizon for growth. The formula calculates the future value of all these periodic payments combined. Finally, we'll add these two future values together to get Bobby's total projected portfolio value. For the lump sum growth formula, FV equals future value from the lump sum, basically what Bobby's initial investment will grow to. PV equals present value. This is Bobby's initial lump sum investment, which in this case is $50,000. R equals rate of return per period. This represents the interest or growth rate Bobby expects to earn. N equals number of periods. This is how many time periods Bobby will be investing for. In this illustration, that will be 10, 20, and 30 years. For the annuity growth, FV equals future value from the lump sum, basically what Bobby's initial investment will grow to. PMT equals payment. This represents the amount Bobby contributes each period, which in this case is $5 daily contribution. R equals rate of return per period. This represents the interest or growth rate Bobby expects to earn. N equals number of periods. This is how many time periods Bobby will be investing for. In this illustration, that will be 10, 20, and 30 years. Well, as the saying goes, numbers don't lie. So, let's dive into the numbers, starting with the 10-year projection. Applying the discussed two formulas, after 10 years, future value 1 will be $185,360, and future value 2 will be $35,290. Now that both components are in place, the projected 10-year portfolio value is calculated by summing future value 1 and future value 2, yielding a total of $220,650. Next is the 20-year projection. By applying the earlier discussed two formulas, after 20 years, future value 1 will be $687,175, and future value 2 will be $166,121. Now that both components are in place, the projected 20-year portfolio value is calculated by summing future value 1 and future value 2, which will give us $853,296. Now my favorite, the 30-year projection. This is when the power of compounding is on full display. By applying the earlier discussed two formulas, after 30 years, future value 1 will be $2,547,510, and future value 2 will be $651,136. Now that both components are in place, the projected 30-year portfolio value is calculated by summing future value 1 and future value 2, yielding a whopping $3,198,646. Stick with me, because shortly, I will reveal the exceptional ETF that could transform a one-time $50,000 and a daily $5 investment into an extraordinary $6 million portfolio. Securing the second position on our list is the Vanguard Dividend Appreciation ETF, ticker symbol VIG. This remarkable ETF represents a far smarter and more disciplined approach than traditional high-yield dividend strategies. Too many investors fall into a dangerous trap by chasing the biggest dividend percentages they can find, assuming that a higher yield automatically translates into better income and stronger returns. Funds advertising 4% or 5% yields often grab attention, but those eye-catching numbers can be misleading and may signal underlying weakness rather than genuine financial strength. Instead of chasing yield, VIG focuses on dividend growth, and that distinction is transformative for long-term investors. High-yield funds frequently concentrate on struggling companies that rely on oversized dividends to mask deeper business problems and keep investors from selling. One of VIG's most powerful advantages is its resilience during market downturns. Historically, it has declined less than the broader market, providing valuable downside protection when volatility spikes and fear dominates headlines. Over the past decade, VIG has delivered an annualized return of approximately 11.9%, proving that dividend growth can coexist with strong long-term performance. While VIG may not match the explosive upside of aggressive growth funds, its smoother ride makes it uniquely valuable. For investors approaching retirement, VIG serves as a reliable paycheck replacement, combining rising income with long-term growth in a single, disciplined, confidence-building ETF. Now, let's dive into the numbers for VIG. Let's project what Bobby's portfolio will look like in the future if he invests an initial $50,000 lump sum and adds $5 per day for a total of $1,825 per year. The fund is expected to grow at a conservative rate of 13% per year, which includes both the stock price rising and the dividends he receives being automatically reinvested in more shares. Now, by simply applying the same methodology based on the two formulas used for the previous ETF, after the 10-year period, Future Value 1 will be $169,730, and Future Value 2 will be $33,617. With both components in place, the projected 10-year portfolio value is calculated by summing Future Value 1 and Future Value 2, totaling $203,347. Next is the 20-year projection, applying the same methodology as in the previous analysis. At year 20, Future Value 1 will be $576,155, and Future Value 2 will be $147,728. Now that both components are in place, the projected 20-year portfolio value is calculated by summing Future Value 1 and Future Value 2, which will give us $723,883. Now my favorite, the 30-year projection. Applying the same methodology as in the previous analysis. At year 30, Future Value 1 will be $1,955,795, and Future Value 2 will be $535,089. Now that both components are in place, the projected 30-year portfolio value is calculated by summing Future Value 1 and Future Value 2, which will give us $2,490,884. I know this is fascinating, but stick with me, because shortly, I'll be revealing an exceptional ETF that could transform a one-time $50,000 and a daily $5 investment into a whopping $6 million portfolio. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. Coming in at the third spot is the Vanguard Total Stock Market ETF, ticker symbol VTI. This outstanding ETF is widely known as the Total Market Dominator and is the second pillar of unstoppable ETF investing. Many investors naturally ask how it differs from VOO, which also targets dominance in the American market, and this distinction is absolutely critical because it separates average outcomes from exceptional long-term growth, capable of transforming retirement portfolios. While VOO focuses exclusively on the 500 largest corporations, VTI captures virtually everything worth owning across the entire American stock market, providing exposure that goes far beyond headline stocks. VTI holds more than 3,500 stocks, spanning every sector, company size, and growth stage imaginable. This means you are not only invested in mega-cap giants like Apple and Microsoft, but also in mid-sized innovators and smaller, fast-growing companies that VOO completely ignores. These emerging businesses often become tomorrow's market leaders, and VTI positions you to benefit before they reach the elite ranks of the S&P 500. This broader reach matters profoundly to high passive income and long-term growth investors. Historical data consistently show that small and mid-cap stocks have outperformed large-cap stocks over extended periods, even though they experience greater short-term volatility. While they can feel riskier during market turbulence, they offer significantly more room to grow. By owning VTI, you strategically capture that upside while maintaining disciplined Vanguard ETF diversification, reducing reliance on any single company or sector. The performance metrics validate this approach. VTI manages approximately $569 billion in assets, carries a rock-bottom 0.03% expense ratio that protects your wealth, and delivers roughly a 1.12% dividend yield to support steady passive income. Since its 2001 launch, VTI has generated total returns exceeding 484%, rewarding patient investors who stayed committed through uncertainty. Perhaps most powerful is the psychological edge VTI provides. It has survived the dot-com crash, the 2008 financial crisis, the 2020 pandemic collapse, and the brutal 2022 bear market, recovering every time and reaching new highs. Owning VTI is owning the entire American stock market in one simple purchase, allowing you to grow wealthy alongside America's long-term economic expansion. Now, it's time to check out VTI's numbers. Let's project what Bobby's portfolio will look like in the future if he invests an initial $50,000 lump sum and adds $5 per day, for a total of $1,825 per year. This unique fund is projected to grow at 14% annually, when both the stock price increases and dividends are automatically reinvested to purchase more shares. As in our previous projections, the calculation is divided into two parts, because Bobby's upfront $50,000 and his daily $5 additions grow at different rates over time. Applying the same methodology as in the previous analysis, at year 10, future value 1 will be $185,360, and future value 2 will be $35,290. Now that both components are in place, the projected 10-year portfolio value is calculated by summing future value 1 and future value 2, yielding a total of $220,650. Next is the 20-year projection. Applying the same methodology as in the previous analysis, at year 20, future value 1 will be $687,175, and future value 2 will be $166,121. Now that both components are in place, the projected 20-year portfolio value is calculated by summing future value 1 and future value 2, yielding a total of $853,296. Now my favorite time frame, 30 years. Applying the same methodology as in the previous analysis, at year 30, future value 1 will be $2,547,510, and future value 2 will be $651,136. With the components in place, the projected 30-year portfolio value is calculated by summing future value 1 and future value 2, yielding a total of $3,198,646. Stick with me, because shortly, I will reveal the exceptional ETF that could transform a one-time $50,000 and a daily $5 investment into an extraordinary $6 million portfolio. Taking the fourth spot on our list is the Vanguard International High Dividend Yield ETF, ticker symbol VYMI. This elite ETF represents something radically different from conventional ETF investing wisdom, and this was 2025's absolute superstar that flew completely under the radar of mainstream investors. Most wealth builders have never even heard of this passive income powerhouse, making the opportunity even more compelling for those paying attention. Let me hit you with the headline that changes everything. VYMI delivered a staggering 29.6% return in 2025, nearly doubling the S&P 500's respectable 15.6% performance. International stocks finally seized their moment after years of underperformance, and VYMI led that unstoppable charge toward exceptional long-term growth. Now, just in case you're wondering what exactly makes this unique ETF so powerfully different, well, check this out. This ETF holds over 1,500 dividend-paying companies from beyond US borders, capturing European banks, Asian manufacturers, global energy giants, and consumer companies spanning developed and emerging markets worldwide. The expense ratio is 0.17%, slightly higher than domestic Vanguard ETFs, but remarkably reasonable for comprehensive international exposure that diversifies geopolitical risk. The dividend yield hovers around an impressive 3.2%, roughly 3 times that of the S&P 500, while the price-to-earnings ratio of approximately 13 indicates international stocks remain dramatically undervalued compared to expensive US equities. In 2025, this ETF exploded after Germany announced massive $1.3 trillion investment in infrastructure and defense spending, which ignited European growth. Also, the weakening US dollar supercharged returns for American investors holding international positions. And the European financial and energy sectors experienced tremendous performance that rewarded patient believers. Now, it's time to check out the numbers for VYMI. Let's project what Bobby's portfolio will look like in the future if he invests an initial $50,000 lump sum and adds $5 per day for a total of $1,825 per year. This unique fund is projected to achieve 14% total returns annually through a unique combination of moderate stock price growth and an impressive 3.58% dividend yield that automatically reinvests to buy additional shares. Applying the same methodology as in the previous analysis, at year 10, future value 1 will be $185,360, and future value 2 will be $35,290. Now that both components are in place, the projected 10-year portfolio value is calculated by summing future value 1 and future value 2, yielding a total of $220,650. Next is the 20-year projection. Applying the same methodology as in the previous analysis, at year 20, future value 1 will be $687,175, and future value 2 will be $166,121. Now that both components are in place, the projected 20-year portfolio value is calculated by summing future value 1 and future value 2, yielding a total of $853,296. Applying the same methodology as in the previous analysis, at year 30, future value 1 will be $2,547,510, and future value 2 will be $651,136. With both components in place, the projected 30-year portfolio value is calculated by summing future value 1 and future value 2, yielding a total of $3,198,646. Claiming the fifth and top spot on our list is the Vanguard International High Dividend Yield ETF, ticker symbol VGT. This ETF is the wealth engine turbocharger for explosive growth and offers a direct way to own the engine behind the modern economy. Over the past 10 years, it has delivered an astonishing total return of roughly 330%, fueled by what may be the greatest technological revolution in history. From automation and cloud computing to artificial intelligence and semiconductors, technology continues to drive US productivity and global expansion. And VGT places you at the center of that momentum where innovation and capital converge. The fund holds approximately 320 technology stocks, but it is intentionally concentrated in the industry's most powerful and dominant winners. With heavy exposure to giants such as Apple, Microsoft, and Nvidia, you are not speculating on unproven ideas or fringe technologies, but investing in the companies actively shaping how the world works, communicates, and builds wealth. When you buy VGT, you are making a clear and confident statement that technology will continue to lead markets, disrupt industries, and compound value over time. Despite its extraordinary performance, VGT remains remarkably inexpensive. Its 0.1% expense ratio means you pay just $10 per year for every $10,000 invested, a fraction of the cost charged by most actively managed technology funds. The reward for accepting short-term volatility has been exceptional. Over the past decade, VGT has produced approximately 22.1% annualized returns, turning a $10,000 investment into more than $73,000, more than double what a broad market fund would have delivered over the same period. That power, however, comes with real risk. When fear hits the market, technology stocks are often sold first and hardest. In 2022, the technology sector fell nearly 30%, significantly more than the broader market. For investors over 50, this makes VGT unsuitable as a core holding for all savings. Instead, it belongs in the portfolio's growth allocation, reserved for capital you will not need for at least 8 to 10 years, where time can smooth volatility and allow compounding to work its magic. Now, let's dive into the numbers for this exceptional ETF. Let's project what Bobby's portfolio will look like in the future if he invests an initial $50,000 lump sum and adds $5 per day for a total of $1,825 per year. This exceptional fund is projected to deliver 17% total returns annually through a combination of aggressive stock price appreciation and a modest 0.40% dividend yield. Applying the same methodology as in the previous analysis, at year 10, future value 1 will be $240,340, and future value 2 will be $40,867. Now that both components are in place, the projected 10-year portfolio value is calculated by summing future value 1 and future value 2, yielding a total of $281,207. Applying the same methodology as in the previous analysis, at year 20, future value 1 will be $1,155,280, and future value 2 will be $237,310. Now that both components are in place, the projected 20-year portfolio value is calculated by summing future value 1 and future value 2, yielding a total of $1,392,590. Now the 30-year projection. Trust me, this data unveils numbers that might seem almost incomprehensible, but are simply the mathematical result of technology's exceptional growth compounding over 3 decades. Let's check it out. Applying the same methodology as in the previous analysis, at year 30, future value 1 will be $5,553,235, and future value 2 will be $1,181,577. Now that both components are in place, the projected 30-year portfolio value is calculated by summing future value 1 and future value 2, yielding a total of $6,734,812. And the most remarkable aspect is that Bobby would have invested only $104,750 of his own money over those 3 decades, meaning the 17% compound growth delivered over $6.6 million in pure investment gains. Now, here's the reality. We're all at different points in our wealth-building journey, facing unique goals, risk tolerances, and timelines. What works for a 25-year-old aggressive investor won't work for a 55-year-old planning retirement in a decade. That's why I'm sharing this allocation strategy, not as a one-size-fits-all solution, but as a framework for you and Bobby's consideration. Option 1. Diversification and international exposure. This strategy creates a truly balanced global portfolio by anchoring 60% in US equities through VTI and VOO, while allocating 30% to VYMI for international diversification and superior dividend income. This approach reduces home country bias by spreading investments across developed and emerging markets worldwide. The 10% VGT allocation captures technology sector upside without excessive concentration risk, while 10% in VIG adds quality dividend growers for stability. This portfolio suits investors seeking geographic diversification, moderate growth, and decent income without taking extreme sector bets. Option 2. Growth plus income. This strategy balances aggressive technology growth with reliable dividend income. Allocating 30% to VGT captures explosive tech sector returns, while 40% total in VIG provides quality dividend growers for stability and growing income. VYMI at 20% delivers high international dividends, plus global diversification. The remaining 10% in VTI ensures broad US market participation, creating a portfolio targeting both capital appreciation and meaningful cash flow. Option 3. Conservative income. This strategy prioritizes steady dividend income by allocating 60% to the highest yielding funds, VYMI and VIG, ensuring substantial quarterly cash flow from quality dividend payers both domestically and internationally. The 20% VTI allocation maintains broad market exposure, 10% VOO provides large cap stability, and just 10% VGT offers modest growth potential. This portfolio suits investors approaching or in retirement who need a reliable income with lower volatility, accepting slower growth in exchange for consistent dividend payments and reduced portfolio fluctuations. As the saying goes, numbers don't lie, and the opportunity won't wait. If you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. Thank you, my friend.